this video, we are going to review 7 key tax changes that affect international structures with assets in Kazakhstan and how to take them into account when planning business in 2026. So the first change is the abolition of the 3-year dividend tax benefit, which currently until the end of 2025 applies and allows to use a reduced 10% withholding tax rate to dividend distribution from Kazakhstan to foreign investors, provided that the investor holds the subsidiary in Kazakhstan for more than 3 years. And exceptions are made for subsoil users, distributions of dividends made by subsoil users, and payments to investors from so-called jurisdictions with so-called preferential tax regimes. But otherwise, the reduced rate applies. But starting in 2026, this tax benefit is going to be abolished. However, the second change is that a reduced rate of 5% is introduced to dividends distributed to foreign investors within a limit of 230 monthly calculation index, which is just below $2 million. If the ownership is at least 25%, so investors that have shares in subsidiaries in Kazakhstan that are at least 25% can enjoy, starting next year, 2026, can enjoy the reduced 5% rate, unless the distribution is made to a state with a preferential tax regime. So what to do in the context of these 2 changes is to review applicable withholding tax rates in 2025 until the end of year and next year in 2026, and to assess whether it is worthwhile to change the schedule of dividend distribution and to postpone or accelerate distributions of dividends to enjoy the reduced rates which applies this or next year. It is also necessary to take into account that a reduced rate of 5% is achievable under many tax treaties that Kazakhstan has with other countries. However, it is not so simple. And the third change is that the rules to apply tax treaty benefits and reduce withholding tax rates are changing starting in 2026. Currently, until the end of 2025, it is possible to apply a reduced withholding tax rate based on tax treaties of Kazakhstan if the income that the foreign investor receives is subject to taxation at a rate of at least 15%. So there is a subject to tax requirement to enjoy the reduced tax rate upon payment of income from Kazakhstan to other countries. But starting next year, this subject to tax condition is abolished, and tax raising certificates and beneficial ownership criteria still apply, and the document called a tax raising certificate is still required. But it means that the subject to tax is no longer necessary, which makes it easier to apply the reduced withholding tax rates under tax treaties that Kazakhstan has with other countries starting next year. At the same time, the practice of applying the beneficial ownership concept is actively developing in Kazakhstan, and we see more and more instances where the tax authorities in Kazakhstan challenge tax treaty benefits on the grounds that the foreign recipients of income is not the beneficial owner of this income. And this is demonstrated by current practice and developing case law in Kazakhstan. So what to do is to review the applicability of tax treaty benefits this and next year, considering the changes, and to assess again whether it is worthwhile to adjust the payment schedule to adapt to the upcoming changes and to the developing practice, and to strengthen the application of the reduced withholding tax rates under tax treaties. The fourth change is the abolition of the 3-year capital gains exemption, and up until the end of 2025, foreign investors that dispose of subsidiaries in Kazakhstan can exempt their profits from such transactions, provided that the holding period exceeds 3 years. Again, the exception is made for sales of subsoil users and gains derived by investors from so-called states with preferential tax regimes, but otherwise the exemption applies until the end of the year. Starting next year, this exemption is abolished. However, it will still be possible to claim an exemption under an applicable tax treaty that Kazakhstan has with the country where the investor which sells the subsidiary in Kazakhstan is located. So what to do again is to assess the applicability of the 3-year exemption for capital gains in the current structure, and to consider restructuring or changes, or maybe even accelerating the sale of assets until the end of the year to make sure that the exemption applies, or otherwise to make sure that next year tax treaty benefits can protect capital gains from taxation in Kazakhstan when selling assets in Kazakhstan. Next, with the fifth change is the reduction of interest withholding tax rates on payments from Kazakhstan to foreign lenders. And currently, until the end of 2025, the basic withholding tax rate for interest is 15%. Next year, it may be reduced, or currently, it can be reduced under applicable double tax treaties to 10%. But next year, the basic domestic withholding tax rate for interest from loans, credits, and debt securities will be set at a rate of 10%. Without the need to apply tax treaty benefits, which obviously makes it easier to apply the 10% withholding tax rate, which is the minimum achievable tax rates under tax treaties that Kazakhstan has with some other countries. So what to do is to assess the applicability of tax treaty benefits for interest payments this year, and consider adjustments to payment schedule and interest payments, and maybe postponing interest payments, and reschedule the interest obligations in a way that next year the 10% withholding tax rates applies more easily. The sixth change is the change in the definition of royalties and the practice to apply withholding tax to royalties. First of all, starting in 2026, withholding tax does not apply to maintenance services provided they are specified separately in license contracts from the royalty income. And currently, there is an emerging case law in practice of classifying service fees as royalties for withholding tax purposes, and we see more and more cases emerge where the tax authorities try to classify as much income as they can as royalties, because royalties are subject to withholding tax of at least 10% under double tax treaties, while services can be exempt from withholding taxation at source. So what to do is to review the current structure of royalty payments and ensure that the reduced rate applies, or the exemption can be claimed for payments that classify as services, and to develop defense strategy, and maybe to make changes to the agreements in order to classify as much income as services as possible. Consider it to state the service income separately. And finally, the seventh change is the reinstatement of the withholding tax exemption for Astana hub residents. There is a technopark in Kazakhstan for IT companies, IT businesses, and starting from 2026, withholding tax exemption starts to apply to payments of royalties made by Astana hub residents to foreign counterparties, which is a welcome change. So what to do? Again, consider schedule of royalty payments and to assess the necessary adjustments to enjoy the exemption that starts to apply next year. And last but not least, finally, there is an exemption introduced to so-called capital contributions to property. Starting 2026, such contributions are going to be exempt from corporate income tax in Kazakhstan, which is not the case until the end of 2025. And again, this is a welcome change, and here one can consider to make capital contributions into property, which is not formal capital. It doesn't increase the capital, the paid-in capital of the subsidiary, to postpone such investments and to schedule such investments for 2026. This is it, and again, you see our contact details on the slides, and we continue to advise clients on complex international tax matters, and I'll be glad to receive your comments and requests. Let's keep in touch, and thank you for watching.